Hey everyone, welcome back to another episode of the Meet Kevin Show. Today, we get to go deep on crypto. And what better way to do it than to bring over George from CryptosRus, YouTube channel focused on crypto news and all things crypto, to help me get to the bottom of some of the potential downsides of crypto. Are these downsides overblown? Are they real? Do we have to be worried? Or is it all up from here? Let's bring in George. Welcome aboard.
Hey, thanks for having me, Kevin.
Absolutely. So tell me, what's on your mind? There's been a lot of talk recently about the stability of stable coins, the future of Bitcoin. What's on your mind?
There's a lot on my mind.
Yeah.
But I think right now, the number one question a lot of people have, especially newcomers, even your last guest, I think the number one question is, are we coming to a top? Is Bitcoin going to repeat like what happened with 2017, right, and previous cycles? And I view this cycle very, very different from previous cycles. So short answer, no, I don't think we topped out. But long answer is, I think people don't realize that traditionally in the past, Bitcoin follows this thing called 4-year cycle. And it's 4 years because according to the code, every 4 years, there's a halving event where the number of Bitcoins that gets produced per block gets cut in half, which makes Bitcoin more scarce, which decreases the inflation rate, basically, essentially. So based on that, usually the first 3 years of that cycle, Bitcoin tends to come down. And the 4th year is when you have that explosive growth, and usually it tops out, and then the cycle starts over again. It tops out, comes down, and then it starts another 4-year cycle. So 2020 was when the last halving event occurred. So 2021 is technically the 4th year of the cycle, which is the most explosive year, which we should see tremendous gains this year, and we have already. But I think what's different this time around is institutional adoption, which never occurred before.
Sure.
So that's a big thing. That's a big driver. We're seeing Bitcoin get pushed to over $1 trillion in market cap, which not too long ago would just seem like it's impossible, right? When Bitcoin was down to 3,800 back in 2020, no one thought that realistically Bitcoin could get to 50,000 or 100,000 this quick, right?
Yeah.
So, and that's because of institutional adoption. There's so many institutions and even public trade companies. Everyone is jumping in because they need a Bitcoin strategy at this point, and that's why it's very different now than previous years. So that's a long answer to that.
Yeah. You just mentioned they need a Bitcoin strategy, aka these institutionals. Isn't it possible that institutional investors are just seeing retail buyers and retail households going, hey, we want some exposure to Bitcoin? And is it maybe that institutional investors are kind of just following retail investors here? Or is this like institutional investors actually understand it better than retail? Like, are they ahead of us or are they behind us, right? Are they playing catch up? Where are they?
I think institutions are definitely behind the retail investors in this space. Bitcoin has always, done its thing within the last 11, 20, 12 years. A lot of volatility, but basically it held on, it held true, and kept going because you have a collective group of people that really believe in it. Some people believe in Bitcoin because they see it as a store of value. Some people see it as a way to disrupt the central banks of the world and what they're doing, right? Especially like right now, we see that, right? So there's many reasons why. So retail investors held strong. And you could equate that with many things, even non-crypto, even equity-wise, like if you look at Tesla stock, or Apple, back in the day, right? You have a collective group of people that really believed in it and just really carried it no matter what Wall Street or anyone else said, right? So I think Bitcoin was led by retail investors. Now institutional investors, they see it and they don't quite understand it, but what I'm seeing is they're kind of FOMOing in. So, retail investors are known for FOMO, right? Fear of missing out. But institutions are now doing that too, because you have a couple guys that really set the bar. Even someone like Cathie Wood, she has come out and said very good things about Bitcoin. And of course, I don't know if you know Michael Saylor of MicroStrategy. Yeah. Of course, he's
all in.
Yeah, he made a big splash. Came out of nowhere. No one knew who he was until pretty much the end of 2020, and said, "I'm putting all my money from MicroStrategy into Bitcoin." And he really opened people's eyes. And same thing with people like Cathie Wood and Scott Miner of Guggenheim and all these guys. They're just saying nothing but good things now. Even the banks that were very traditionally very anti-crypto and Bitcoin, they're all coming out with trading desks or custodian services, and they're all jumping in, right? So now that's why I think everyone's looking at Bitcoin and coming up with a strategy with it. Is some may not even realize what the main benefit is, but they can't be left out. So that's why I feel like a lot are just FOMOing in at this point. But of course, there's a lot that really understand it too.
Yeah. What do you say to people who are like, hey, sure, maybe the institutions are getting in, but they're getting in just to like sell their funds. Nobody's fundamentally valuing it, right? That fundamental analysis argument always comes up. Like, is this just, somebody's willing to pay more than the next guy?
So there's a couple people, I won't name names, that will say Bitcoin has no intrinsic value.
Sure.
And the thing is, I think most people that kind of know little about finance, and I don't claim to be a very financial guy. I don't know all the inner workings, but I do know that something like the USD is not backed by gold anymore. Hasn't been for decades, right? So a lot of people still look at it that way, like Bitcoin is digital. It's not backed by anything. There's no intrinsic value. But you look at something like the USD, it also is not backed by anything. And what's worse is the USD is inflated. Before it was 2% every year. Now it's a lot more because of all the printing that was done last year and this year, right? So, so this notion that it has no value, or that someone will only buy it just to sell it to someone else, at a higher price. But that's how anything works.
That's true.
Right?
Stock, real estate. I mean, it's true. Somebody's got to pay me more for it. Otherwise it's valueless. So, I mean, I guess that's just sort of like a redundant argument. Like, yeah, it's an asset. Like, that's how it works.
Exactly. I mean, some people will make the point like, oh, Bitcoin is not as good as gold because it's not physical. And if there's a power grid out, like an Armageddon situation, and all the electrical power grids go down, then Bitcoin is useless. Well, in that case, I would argue gold would be useless. Bullets and food and basic necessities would actually rise in value, right? So you can't argue that just because Bitcoin is digital, it's not worth anything. This notion of you have to make a profit by selling to someone higher. That's anything. Real estate,
good point.
Collectibles, cards, priceless art, even like things like NFTs. They all work on the same premise.
Yeah, true. Is there a way that you kind of look at Bitcoin and how that you determine, okay, now it's undervalued, now it's overvalued, and like how would you see that?
That's a good question. How I look at it now is kind of what I hinted earlier about adoption, institutional adoption, and it goes really beyond that too. You're starting to see countries also come up with a Bitcoin strategy. There are countries that,
except for India.
Well, they flip back and forth, so it always happens. I don't know what it is about India, but but there are countries where their inflation is out of control, right?
Yeah.
So and there are countries that honestly they're looking fully at coming out with a digital fiat version of their currency, right? So we know China's doing that with their digital yuan. Russia is rumored to be doing that. United States is looking to do that, right? So everything is moving in that direction. And you know what? I look at that. I look at how big financial firms, hedge funds, family offices, pension funds, everyone getting in. And that's how I'm making my determination that the top is nowhere near and how this could keep going and why it's undervalued. And there's something I shared with you. I don't know if you could pull it up, that site that shows the USD equivalent to sats. I think this is a very telling story for people that aren't aware of inflation and how it's real.
Let's see it. So $1 is currently worth 1790 SATs.
Right.
Okay, what is that?
Sats is just Bitcoin could be broken up. You don't have to buy whole Bitcoins. I think that's also a misconception
these are
for a lot of
Satoshis.
newcomers. Yes.
Sats is just a nickname. Okay, yeah. I've started my Bitcoin journey in January, so I'm trying to put all these things together.
So roughly 100 million Sats is one Bitcoin. So 10 years ago, with one single dollar, you could have bought more than one Bitcoin with it.
Wow.
And go down 9 years, 8 years, 7 years, 5 years, and then look at the percentage change. So you could argue that fiat or the dollar has depreciated versus Bitcoin by that much within a very short amount of time. Now, also Bitcoin appreciated too, but it just depends on how you look at it. So this is one of the reasons why, like,
this
an asset,
is a logarithmic scale right here, because it's going from 100 million to 10 mil to 1 mil. So this is a logarithmic decline here. So I mean, this would be even more extreme if this were linear. I mean, it would just be like probably like a straight arrow down.
yes, and this is the reason why. This is the reason why I believe everyone should have a Bitcoin strategy or should own some Bitcoin because of this. Because when you versus, like, let's say, 2%, 3% inflation, you don't really notice it. But when you versus an asset, not just Bitcoin, like real estate or stocks, when you versus an asset, you'll realize how much the US dollar is really deflating, right? So I mean, inflating.
Yeah. So what percentage of your portfolio are you throwing into Bitcoin? I mean, are you just like, I'm all in?
Yeah, pretty much.
My gosh. Okay.
Much.
Wow, that's impressive. So is it just Bitcoin, or are you diversifying into like the Doge and the Ethereum?
Yeah. So you know how traditionally, like fund managers or portfolio managers would say you should break up your portfolio 60-40, right? So something I've come up with is the 50-25-25 rule, which is 50% in Bitcoin, 25% in what I call big caps of altcoins, which is anything worth $10 billion in market cap or higher, and then 25% in smaller caps, anything that's under $10 billion. And with this kind of breakup, that's what I'm following. I have the stability and growth of Bitcoin still. I have more growth with the big caps because they tend to move faster than Bitcoin. And small caps also, there's tremendous growth. There's a lot of promising projects out there that really can stand on their own. And you can see that. So, yeah.
What about, I mean, like, so the other day I was, I've talked to, for example, BlockFi since, but, I want to touch on, well, let me ask you. Hold on. Let me finish this portfolio train of thought, and then I want to get into the stable coins. So to restart that, are you in Doge then? Are you grabbing into Cardano because you believe in these projects?
I'm not holding Doge, and I'm not holding Cardano right now, but they have their purpose. A lot of people love Cardano because the leader, Charles Hoskinson. And it's an unfinished project. It's been ongoing for quite some time, but there's a large number of people that really believe in Charles and believe what Cardano could become, which is why it has gone up so much.
What's holding you back?
I kind of just missed the train on that. I just kind of missed the train.
Appreciate
there's been so many others that got in, and Cardano has gone up like thousands and thousands of percents. I just feel like there's better buys at this point for me. Okay, so doesn't mean that there isn't more growth to it.
so Bitcoin, what are the other ones?
There's a whole lot. Oh
man. Okay, so you like got an index fund after Bitcoin almost.
Yeah, sort of. Like my portfolio breakup, which I don't share, but I have probably like 40 altcoins in there.
Oh, whoa.
Yeah. And
Is
there's a
Ethereum
lot.
considered an alt these days? Because it's number 2. But...
Anything that's not Bitcoin is an altcoin.
Okay. Okay.
That's traditionally how it's been categorized, and I still believe in that because nothing competes with Bitcoin. Bitcoin is a store of value. It's a technology. It's a medium transfer, but ultimately, I believe it's a store of value. Everything else.
What do you believe when you hear like Jerome Powell say something like, we don't think it's a good store of value, and they question it because of volatility, which is like we've heard this from the mainstream and the traditional folks frequently. And so how do you respond to those allegations?
Well, I think he has to say those things. He cannot. I don't think he could just come out and say, I think Bitcoin is a fantastic store of value and everyone should be buying Bitcoin. I don't think he could say that. But yeah, I think that website that I showed you,
yes,
tells it all. It's been growing, I think annually 200% year over year versus the USD. So how can you not say it's not a good store of value when it has gone up within the last 10, 11 years, millions of percents. And within the last, even if you look at 2017 and how it went down from 20,000 all the way down to like 3,100.
Yeah.
But, relatively speaking, you wait 3 years and now you're 300% higher, roughly. How's that a bad thing?
What are the odds of us seeing this again? What are the odds of this kind of run again in the future? I mean, sure, we mentioned earlier, look, it's at $1 trillion now. We never thought it would go to $1 trillion. Is this going to go to 10 trill like the gold industry? I'm pretty sure gold's like $10+ trillion, right? Are we going to see Bitcoin there? Is this just going to keep going?
Yeah, I think that is definitely going to happen. At this point, many, including myself, think that Bitcoin will equal gold's market cap and then surpass it. Now, it doesn't mean that it's going to happen within this cycle. It could be the next cycle after that. But I think people are realizing that gold, and I'm not trying to bash gold, but gold has not been doing very well within the last 10 years at preserving wealth, being a store of value. Gold's price now is lower than where it was 10 years ago. So that's a telling thing. And I think a lot of institutions now that are buying Bitcoin, that are trying to come up with a Bitcoin strategy, I think they're actually selling off gold to buy Bitcoin, not equities or anything. And JP Morgan even said so as well. I mean, they came out and said, we think gold is going to kind of suffer because a lot of companies are going to be selling off their gold to buy Bitcoin. So if that's happening, and we're seeing that already, there's no doubt in my mind that Bitcoin will equal gold's market cap in the near future.
Is it possible that this thing plummets back to 5K here in the future and then causes some massive ripple effects through the market?
I wish it did, because that I would put even more all in.
Okay.
Right? It's one of those things that sure, anything could happen. I sometimes say this kiddingly, but of course anything can happen. World War III could happen. Aliens could invade. Something of a zombie apocalypse could happen. And of course, then Bitcoin is not very useful at that point, right? But seeing where it is now and seeing the strongest hands, I would say, the large institutional investors that are buying it, traditionally they would hold gold and others and bonds and stuff like that for decades. Why would they just buy Bitcoin now and just try to sell it off for a little profit? They would be holding on for long term, because I don't think their expectation is to make, to go to the moon with Bitcoin. Their expectation is simply to just preserve wealth. That's it. Right. And if it does that better than gold, they're just going to continue to hold it.
One thing that Cathie Wood recently mentioned is that Bitcoin might be an interesting investment for institutions because it doesn't correlate exactly with the market like the S&P 500 or even the Dow. It has a very low correlation to the Dow, almost as low as real estate correlates to the Dow. Do you think that if people pick up this argument that Bitcoin could just be this diversification asset then that, yeah, so what? If it goes down, fine, we'll buy some more. If it goes up, cool, great.
Yeah, so there's that argument. Some people will argue that Bitcoin does have a correlation, and some people argue it doesn't. Like Chamath has come out, he's a big Bitcoin guy. He has come out and told everyone many times to buy at least 1 to 3% into Bitcoin because it is a non-correlating asset against the markets. So, I mean, when you have like a catastrophic event, like what happened in March of 2020, everything's going to correlate a little bit, okay? Stocks, the Dow, everything went down, plummeted. Bitcoin went down at that time. And then even gold at that time came down. But, you know, during like recovery periods, that's where you see the real non-correlation. Because since then, you could see that, you know, even though equities market has done well, gold has somewhat done well, but look at how well Bitcoin has done, right? So in terms of correlating and non-correlating, I generally think that there is still some correlation, but it's widening. And it's going to get to the point where eventually if, let's say, the equities market, you know, the next crash comes, Bitcoin not only holds, but also gains. And that's when you will see true non-correlation between Bitcoin and everything else. Right.
Yeah. That would be crazy because, you know, in last March, everything fell. Well, with the exception of real estate. It's like we saw, you know, Bitcoin and stocks a plummet. But that would be very interesting if the stock market plummeted and Bitcoin was like mooning, you know, which could potentially happen under an inflationary environment. Are you expecting big inflation? Is that one of the reasons you're seeing, you know, you're pushing so convincingly into crypto?
See, this is where I wish I had a better financial background, because there's a lot of analysts and economists that would argue about, are we really going to see hyperinflation, or are we just going to see normal inflation, or we're not going to see any inflation at all, right? But generally speaking, to dumb it down, you know, is if you look at how much money that exists in terms of fiat, and if that money supply goes up by 20% within a single year,
which it did,
yeah. And then another, I don't even know what it is, I think another 10 or 15% based on the stimulus package this year. Yeah. So that has to have effect, right? Because now the pool of money just expanded. So there has to be inflation. That's how I view it. But I know there's people argue like tech would be deflationary, and there's other things that kind of curb that. But you know, seeing how Powell is basically saying, I'm not going to raise interest rates until 2023, and you know what, I'm going to continue buying, you know, junk bonds and continue going. I don't know. It just seems like there is going to be inflation, and if you do want to hedge against it, you have to buy assets that does not depreciate like USD, right? And I see Bitcoin being the best asset to buy at this point.
What about, though, is it possible in a weird way that we've seen a lot of people invest in cryptos as an inflation hedge, and potentially because so much money is flowing into cryptos, maybe we're actually hiding or preventing inflation from happening in the first place by all this money flowing into crypto investments? If we add up all of the, you know, market caps of, you know, Bitcoin and the latest gains and all the altcoins and all the NFTs, right? Like maybe that's where all the money printing went.
It could be. I mean, the market is definitely blooming right now, and there's new innovations that's coming up. That's what's awesome about crypto in general. You know, Bitcoin led everything, and it still does. But now, because of Ethereum and other guys, they have introduced, you know, token offerings, which was very hot back in 2017. Not so much now; it still happens, but then we were introduced to NFTs, which wasn't popular before, but is very popular now. And also DeFi came out of this too, right? And to a point like hybrid DeFi or CeFi, like lending companies. So there's just so much innovation going on. It's very early. A lot of it is, of course, speculative, but that's why people are excited about it. And I also think why altcoins in general are doing well is because, unfortunately, I think a lot of retail investors coming into the space, they look at Bitcoin and they're like, oh, it's 55,000 to 60,000. I don't want to own 0.001. I want to own 1 or 10 of something. So they also look at altcoins, and that new money coming in is actually driving altcoins much higher, and some of these innovations. So
is there a concern that like what happens if in 3 or 4 months we go through, maybe some short-term inflation, but then all of a sudden inflation disappears, somehow, we don't know how, but somehow we did all this money printing. Biden did another $4 trillion in infrastructure. And here we are, it's August, July, or August, September. And we're all sitting here going, what? How is there no inflation? How did prices of food come back down? How did prices of chips and lumber and metal, how did those things come back down? But then, like, the Fed was right. We just didn't see inflation. How? And what happens to crypto then? Like, maybe we don't need a crypto hedge.
In that scenario, which is very unlikely, I would say. But even if that happened, for retail side, I would say nothing changes because, there's a lot of speculative things, a lot of new innovations, and a lot of people view it as trying to invest in Apple, Google, Microsoft very early, like before they become the big powerhouses. And I do believe a lot of these projects will end up being that way, being the big decentralized powerhouses of the future. So from a retail perspective, I don't think it's going to change. If there was zero inflation, then I would say maybe institutions would change their mind, because then they would go back. They would go back to traditional investments that they do. But, I would say that my guess is that institutions would probably curb their buying. But then again, so many of them are going full-blown crypto services, and they're just not going to ditch that all of a sudden. Like, like Fidelity is coming out with, they already are a custodian for Bitcoin. They own mining farms. I don't know if you know, they own 10% stake in Hut 8 mining. And they're also trying to come out with the Bitcoin ETF, right? So they're like kind of all in already. I just don't see them saying, okay, we're just going to stop all of it. And Goldman Sachs is also opening up a crypto trading desk, and they're going to help institutions get involved. And so there's like, I guess the infrastructure is already being built, and it's just, I don't see that going away also. So
that makes sense. Yeah. So much. So the more almost like infrastructure we have around this, the stickier it becomes, which they also say that the more we use, let's say, Bitcoin, the stickier and less volatile it becomes as well, huh?
I would say not usage, but more of liquidity. The higher Bitcoin
can you define that difference?
I'm sorry?
Oh, sorry. Can you speak to that difference?
Yeah. So just because you have a bunch of people, let's say they transact in Bitcoin, which is really inefficient. There's better ways to do that. A better crypto, I should say, to do that. But in terms of liquidity, I think that's ultimately what's going to curb volatility. So, for example, right now at 1 billion, the volatility, those swings that we're seeing up and down, yes, there are still swings, is way less than when Bitcoin was at 10,000 and way less than when it was below 10,000. So as Bitcoin's liquidity, or basically overall market cap, goes higher and more people are hodling Bitcoin, right? Then, there's just really not much, there's not going to be as much volatility because there's less people that are trying to day trade or swing trade it. Most would just be buying and holding it. So,
well, what happens though in the event of a crash? I want to touch on that. There's I heard one of the risk managers over at BlockFi say, hey, look, if we have a sudden crash or whatever, miners might be disincentivized to mine, and you start seeing some mines shut down. I know there's some formula adjustments or whatever, but they were talking about, and I want to ask you about this, they were talking about how you could see transactions go from, a 10-minute speed to like a 12 or 13-minute speed. And this could create liquidity issues very quickly, even these minor transitionary moments. Any concerns regarding, how basically the incentive to mine reduces in the event of a crash?
Yeah. So that did occur. But that's one of the beauties of the Bitcoin code is that the difficulty, which is the algorithm that all the miners are trying to solve, and when they do, they get rewarded in Bitcoin. That the difficulty of the algorithm changes every 2 weeks. It's set that every 2 weeks adjusts. So if it detects that there are a lot more miners trying to solve that equation, the difficulty will adjust and become more difficult. And if it detects that a lot less is trying to solve, it will get easier. So this notion that if there's a big crash, that the miners will become unprofitable and just shut down, the worst case scenario is it happens for 2 weeks. That's it. Because within the 2 weeks, right, Bitcoin falls to a point where, let's say a miner, I'm just making this up, I don't know exactly how their profit, how the profit is, but let's say they make $1 million per day. This is a large mining farm, right? And let's say Bitcoin, and that $1 million based on Bitcoin being at, let's say 55,000. But Bitcoin falls to 30,000. That means all of a sudden that profit basically plummets almost in half. But if their operations, let's say, is more than that 500,000, then they're technically operating at a loss, right? So that in that case, they would shut down miners because they would try to decrease their operation costs, like electricity costs will go down and stuff like that. Sure. But after 2 weeks, then the difficulty adjusts again, and it becomes much easier for them to mine, which means that they can make more Bitcoin to make up for it. So in 2 weeks, they would basically just respin up the miners that they shut off, unless this is like a catastrophic effect where Bitcoin keeps going down for an extended period of time. Right. But you know what? This will keep adjusting. And this happened in March of 2020. There were reports that miners started shutting down a lot of their mining rigs. And there was pictures about they showed in China, there's wheelbarrows of miners just sitting out in the, being thrown away or whatever. I think some of that was fake. But but you know what? The Bitcoin network didn't die. It's not like everyone shut off and they're like, okay, we're done. No.
Right.
The miners, how I view the miners are like the new, kind of like oil. Back in the day, oil, or still, I shouldn't say back in the day, but oil refineries, people from Middle East that own a ton of oil, they're kind of like, they have that cornered. You're just not going to really go find more oil beyond what we already know. But Bitcoin mining is the same thing. There's a lot of miners that start very early. They have built their operation so big. They have a ton of Bitcoin in reserves and they have a ton of money. They're just not going to go away because they know this is what's going to make them into billionaires and possibly trillionaires in the future. So, yeah.
Now, what here's another criticism that comes sometimes of the Bitcoin community is that sometimes the Bitcoin community is not interested in hearing anything remotely negative about a potential downside consequence and evaluating this. Is that unique to the Bitcoin community or crypto community, or is that just like all assets? Like, hey, if you say something bad, whether you believe it or not, but just explore a possible negative scenario. Is that healthy to be aware of the downsides, or is it just call it FUD, click out, dislike, and leave? What's your experience been?
I agree with you. There's many. That's why some people call the crypto community toxic, is because sometimes you have an opinion that maybe not popular, and then you get ganged up on. Dave Portnoy, Barstool, Sports. He entered Bitcoin very little, I think a week, and then he got driven out. And since that, everyone just keeps bashing him on that decision. And I think he's coming back. But yeah, I agree with that. So I do think there should be more open minds in the space, because some people will like a project and some people won't like another project. But then if you say, I don't like this project, you get bashed on for it by the other communities or whatever, right? So I agree with that. But here's the thing too. When you have, I say, this is why I love Tesla and Bitcoin together, because I see two of the most cult-like followings of anything out there. You have people that love Tesla and people that love Bitcoin, right? And when you have a culture like that, it's really hard to stop because they will hold and buy forever, despite what anyone else is saying. And when you have a group of people that will do that, and that group of people keeps increasing, then it's just an unstoppable force.
Right.
So, so it's good and it's bad because I think that's ultimately what carried Bitcoin throughout all these years. When there's mass volatility and everyone thought Bitcoin was going to die, it continued to move forward and thrive, right? And I think, I think ultimately that's a good thing. But yeah, I do think some people should open up their minds more about different things.
Yeah. And now you are 100% crypto. Have you ever been nervous about that? I mean, like, what if you're wrong? I mean, why not have some Tesla stock?
My history of stocks have been really bad, so that's one of the reasons why.
Thank you for being transparent.
I got in first in 2000 with the dot-com bubble. Then I got in heavy in 2007, and then housing bubble. So, here's my new way to think. I find like investors that make, and I could be 100% off, but I find investors that make the most money are the ones that have the most conviction about what they're investing in, right? And I think it's once you have that wealth, you are a multimillionaire, you're a billionaire, okay? Then obviously risk, management is very important. You don't want to lose what you have already. So then I feel like diversification is great. But when you're trying to build that wealth, you want to stick with what you know and stick with what works. And that's why it's crypto for me right now. But I understand if you already built that wealth, then it's a totally different game.
That makes sense. Okay. So did you say you got hit in the 2007? Was it real estate debt or stocks both times?
No, it was stocks. It was always stocks.
Okay.
It's always stocks.
Is that maybe one of those reasons that like you look at Cardano and it's like, no, I've kind of hit, like I've missed the train on that. Is that coming from like that 2007 experience?
Not really. Okay. I guess there are certain, just like all things, just like real estate, I think this is a good example. Once a certain real estate gets up to a certain level, it's just not going to come down anymore. And you kind of just miss that boat, right? And with crypto, there's always new parcels of land. Let's just put it that way. So rather than try to buy a prime real estate, in Manhattan or something, try to buy something in Kansas City. Maybe that will become the next hot spot. But that's kind of how it is with crypto. I think a lot of people that believe in Cardano have held it since it was pennies. And I saw it in 2017. Cardano went from nothing to a multi-billion-dollar project in months. And since then, it has held there and just kind of gone there, right? So I just, in terms of Cardano, it's just one of those things I feel like I've missed the boat. So I feel like there's better promising projects that can make me more money. Let's just put it that way.
That makes sense. Now, this was interesting. This talk about like comparing it to almost plots of land. Isn't that in some sense kind of risky though? I mean, like, like for example, you look at real estate. It's like, okay, well, if I buy right on the coast, there's only so much of that, right? There's only so much, and coastline real estate's probably going to do well whichever coast you're on. But yeah, I mean, what if you do go to an area where it's just like there's nothing? It's like a desert or something like that. There are no houses. There's plenty of it. Is that? I mean, if that's kind of like the altcoin market in certain altcoins, is there a concern that, hey, you're kind of just like planting a seed here and here and here and here and hoping that one of them goes to the moon? But I mean, it almost feels a little like in some altcoins, like penny stock hoping that one of them blows up.
That's a good point, but that's why that 50-25-25 rule I said is important, because vast majority of your portfolio, if you follow it, is in something much more stable. Because when you invest in something small, of course, there's a risk that it's going to go away and just die, and there's bad things that can happen. But here's the difference, though, because a lot of crypto companies now are backed by very influential people and investment companies that that can turn that plot of land into something. So I think that's very important to look at. You're not just investing. What I do when I look at a project is, first I look at the idea. Do I like the idea? Is it achievable? Is it, something that's needed? Yes. And then next, to look at the leadership. Have they done something before? A lot of them are seasoned professionals that have worked in giant tech companies, and a lot of them are entrepreneurs that have created businesses and exited those businesses that made hundreds of millions of dollars. So then you got to look at the track record. If they have done this before, why couldn't they do it now with a new project? Right. So I think that's the thing you got to look at. You got to look at a number of different things. But I think the team, and then also the backers, you have some very prominent people like Tim Draper, for example, very good at tech investing, right? And he's investing in a lot of these projects. So you got to figure, well, if he's investing in it, then maybe there is something to this, right? So that's the difference.
What about there have been, there was how we try to say here, there have been some altcoins that have totally evaporated, like disappeared, or had massive legal issues or whatever. Can you speak to those a little bit? And should those problems be something we consider as, we balance our portfolio?
Yes. And I think the leadership, again, is one that we need to pay more attention to. The ones that have simply disappeared because of mismanagement, or they pulled some kind of exit scam, or got shut down by SEC or some regulatory body, right? Their project founded by people that didn't know what they were doing. And that's one of the bad things about 2017 with the ICO craze, is everyone was making money, so much money, that they're just willing to invest in new projects no matter what it was. And a lot of projects got hundreds of millions of dollars of funding, but they just had a concept. They had nothing built, and the leadership had no idea how to build it. And those were the ones that collapsed. Everyone else that collapsed, kind of like they died because the market, I mean, they didn't die, but in the sense of their price died, is because we had that crypto winter. But a lot of them continue to execute, continue to build upon their vision. And now 3 years, 4 years later, they're done. And they're now really starting to blossom. And a lot of them came back. So with crypto, I always say this, it's almost like, they're almost like, it sounds bad, but it's kind of like they're cockroaches, because it's really hard to kill crypto. It's really, really, really hard to kill crypto. There are crypto that is down 99.9% that have come back to life and have made new all highs. They've been sitting dormant for years, and then they come back. And some of these projects are the big ones that you know of, like Litecoin. Litecoin died after 2014. It literally went to almost zero. It went sub $1. And then it came back in 2017, and now it's a big cap. It's still sitting up there. So there are projects that just because they stay dormant doesn't mean they're dead. So
okay, gotcha. So, geez, I mean, like, you said you have almost like 40 altcoins. Like, what are you just looking for leadership to pick these so that you don't run into maybe those situations where you've got an unscrupulous leader or executive that increases your risk appetite or portfolio rather? How are you picking?
That's kind of my secret sauce.
Okay. Gotcha.
But I mean, it goes beyond that. That's obviously very important. But there's also trends you need to look at. Like right now, NFTs, DeFi is very hot. So that's a trend. Also looking at exchange listings, being listed on the right exchange so that people can actually buy it. That's actually important too. And there's other things I mentioned about looking at the concept of what they're trying to do. Is it realistic? Is it what I call sexy project that people care about? And the leadership, among other things. So there's many things to look at.
Gotcha. For somebody starting out, do you generally just recommend start with like the BTC and Ethereum, or how does somebody go about researching and getting to that next level of understanding?
For anyone starting out, I would say just go with Bitcoin. It's the least riskiest. It still has plenty of upside. And I think a lot of people turn off again by the high price, but they shouldn't, because you should concentrate on the growth. And from where it is now, I think there's still plenty of growth. But before getting into altcoins, and this is unfortunately what a lot of retail investors, they fall into this trap. They get mesmerized by the price, and then they FOMO into something that they don't quite understand. And I feel like that always happens, but that's why I have my show, to educate people on that. Because a lot of people will look at, let's say, Ethereum is really not a good example for that, because it's already really well established. But I don't know, I'm just going to pick Dogecoin, for example. People saw Elon tweet it out. They see it pump up. They're like, oh, this has to be good. I'm going to get into Dogecoin. They don't really understand what it's all about. They just want to get in, and Dogecoin was on Robinhood, so it's like, hey, why not? Let's go buy Dogecoin, right? And a lot of people got burned when it came down. It is still holding relatively well, speaking, but still, a lot of people bought it at 8 cents, 9 cents. Now it's back to 5 cents, right? So that's the thing. It's like, you have to be educated, and there's many ways to do so. There's a lot of websites out there that talk about these projects. There's a lot of YouTube channels like mine that talk about altcoins and stuff like that. So I think new retail investors need to realize they need to stop the FOMO, and they need to just actually do real research before jumping in. But I advise everyone that's starting in to go with Bitcoin first.
Yeah, I hear that the research being so important. Sometimes it's almost hard though to find like really good quality research, and then sometimes we're searching around. And which thank you, by the way, for your channel. But sometimes we're searching around and we look at altcoins, and then we hear about SEC investigating XRP and things like this. Hey, doesn't that concern you? Like once we start getting regulation involved too?
Yeah, I mean it's. Unfortunately, media is media. They're going to drive what sells, basically, what draws the most views. So unfortunately, you look at Bitcoin, you just search Bitcoin on Google. One day, you'll see nothing but positive news. Another day, nothing but negative news. And they flip-flop left and right. So I get, yes, that is actually really hard. If you're trying to figure out, should I buy Bitcoin? Should I not buy Bitcoin? Is it going to go to zero, or is it go to the moon? It's kind of hard to figure out. So the only thing I can say is you gotta take your time. Just like anything, take your time. Spend real time looking at, paying attention to what people are saying. Make your own decisions, right? Don't just listen to what anyone says 100%, right? Ask the right questions. And that's really all you can do. Is just really, really do your research, and don't just follow what anyone else is saying.
Where do you recommend buying it? Price, convenience.
You mean like where to buy crypto? Yeah. There's a lot of places. If you're in the US, the biggest one is Coinbase. The problem with Coinbase is their customer service really sucks. So Coinbase, they're trying to do a direct listing IPO pretty soon, which I think will do very well. They picked a perfect time to do it, like absolutely timed it perfectly. But with that said, the customer service kind of sucks. But if you don't have customer service issues, then you could get on, and the app is pretty easy to use. But for me, I prefer someone like Gemini. Because Gemini is just as easy to use. They're very regulated because they're in New York, they have insurance and all this stuff, and their interface is really easy to use. And I recommend like pure exchanges like Coinbase and Gemini versus say Robinhood, for example, is because they allow you to actually withdraw and deposit crypto, so that if you wanted to move it somewhere else, you can. For example, if you wanted to put your crypto onto a hardware wallet, so you want to secure it yourself, you can actually make that withdrawal out, where something like a Robinhood does not allow you to do that. They just hold it for you.
Yeah, that was one thing that I thought was so interesting about Robinhood. I was looking at my because I do have Bitcoin on Robinhood. Yeah. We originally called this like a drunk purchase on like I think it was the night of the Georgia election. like, oh, I should buy Bitcoin. People are like, yeah, everybody in the comments like, yeah, you should. I know nothing about Bitcoin. Still, I'm just scratching the surface. So I just swipe up on Robinhood, and then like the comments load, everybody's like, no, don't buy it on Robinhood. It was already too late, right? I didn't buy it on Robinhood. And what's funny is like now the money's kind of stuck there because I bought it, as a joke at like 35K. And, now obviously it's more, so it's great. But if I sell it to move it out of Robinhood, I pay taxes, which I don't want to do that. So I'm just going to leave it there. I don't want to pay the taxes. But then it got me. I've been really curious about the space, and I've been price shopping and price matching. And I don't understand how or why, or if this is a loss leader or what. But when I compare Coinbase Pro, Voyager, BlockFi, some of these other platforms, Gemini, to Robinhood, Robinhood beats their pricing. What are they doing?
I don't know the intricacies of Robinhood, but I'm assuming they do something similar to PayPal now. I think they have to buy a certain amount, and they replenish that somehow, like every day, every week. I don't know what happens there, but basically all these exchanges, they have their own order books, and they adjust over time. But some are higher than others because they build in fees that their platform happens to be higher. For example, Voyager fees are generally higher. They don't actually say they have a fee, but when you do a purchase,
the spread,
the spread is just worse. So I don't know how exactly Robinhood does it, but I'm assuming they do it like everyone else. They buy a certain amount. Maybe they can charge less fees. That's why it's a little bit less. Or maybe there's other things, other services they're not paying for that makes it so that they can offer at a lower price. But generally speaking, like Coinbase is, if you look at Coinbase Pro or Coinbase price, that's kind of like the universal price. And you could see if Coinbase price is higher significantly than everyone else, that's usually an indication that there's massive buying going on. And if Coinbase price is significantly lower, that means there's massive selling going on. So that's actually a tell if you look at Coinbase price versus everyone else.
Wow, that's incredible. I'll have to look into that. Thank you for that. So, massive buying drives liquidity down and prices up. So what about these platforms where you can earn interest, the Voyager, BlockFi, and there are lots of these. I mean, there's some that are bigger, and then there's some that are tiny where they're like 40, 50% interest. It's like, well, what? Can you speak to this a little?
There's many different ways to earn interest with crypto, but let's just start with someone like BlockFi. There's a lot in this space. BlockFi, you have Nexo, you have Celsius, and then Voyager. I think that's about right. So these companies, they're kind of like I'm just gonna categorize them like hybrid CeFi DeFi, because obviously they're dealing with crypto. Right. And some of them have their own tokens. So kind of in the DeFi space, but of course they're a centralized entity. And so there's, CeFi too. So I had a chat with BlockFi right before I came on here to kind of clarify things. So
who'd you talk to?
Shane. He's a VP.
Okay. Not
so there's three things going on with BlockFi, and I think most companies are like that. BlockFi doesn't have their own token, so they're a little bit different. Other companies like Celsius and Nexo does, so they have more liquidity because they are also dealing with their own tokens. But BlockFi, they have three businesses. Number one is, as a retail investor, you can borrow. You could borrow against your own crypto. So if you deposit $1,000 worth of Bitcoin, you can borrow up to $500. Okay, it's that simple. It's an over-collateralized loan. So if Bitcoin ultimately falls, then you get margin called and you have to replenish, or there goes sell off and get their money back. But according to BlockFi, they do give you a 48-hour window, so it's not like you get liquidated immediately. They can wait for you to actually put in more collateral.
Well, that's interesting, because I just spoke with BlockFi, somebody else, and they're like, we have the power to liquidate you immediately. And it's like instantaneous. They're like, and I was like, wait, but now you're saying Shane told you 48 hours. They'll give you some time because they want the customer service too, right? But like if things are free falling, like speak to this more. I want to hear more of this.
Yeah, because I've asked that too, because I'm like, because me traditionally, I don't ever recommend anyone to borrow, to basically over leverage themselves. So
Right.
I myself never participate in these kind of projects where I put down collateral and borrow against it for this very same reason. I asked specifically, do you guys just liquidate immediately? And they're like, no, we give you time. We know that this happens. So that I did confirm. So I don't know who you spoke to that I told you otherwise. But that's the one part. But the other part, I think this is where I saw your stream on Millennial Money with the other guys talking about this. When they lend out, so the second part is, okay, let's say you're not taking a loan. A retail investor wants to deposit money just to earn interest. Let's say earn 8% on USDC or something like that.
Yeah.
So on the flip side, how they make that is by lending out to institutional investors. But I was just told they're not doing it on a one-to-one basis. They do it on the same way they do it with retail investors. They force institutional investors to deposit crypto to take out a loan. So most likely it's the same ratio, that 50% ratio, so that they're depositing. If they want to borrow $100 million, then they have to deposit $2 million worth of crypto to be held so that they can borrow that $100 million. The difference is that these institutional investors are paying more interest because they're borrowing a larger amount. That's how they make money and give it to the retail side. So they go through, at least what I was explaining, they go through KYC. They have like some kind of meeting to say if they approve this or not. So they do have that on the backside too. And they also say they do trading. They do their own like internal trading services, internal trading to also utilize to make more profits. But one thing they did clarify is if you deposit, let's say, Bitcoin in, they never take your Bitcoin out of cold storage. It stays there forever. The only thing how they can get cash to lend out is through stable coins. Why? Which is why they give such a big amount of interest on stable coins, because they can take that stable coins, convert it to cash, and lend it out really easily, and vice versa back. So anything that's not a stable coin, they don't touch. It just stays into cold storage. But if it is a stable coin, then they could convert it to cash to lend out. So according to them, they're very, very well. Their reserves is substantial. So that's how they explain it to me. So that actually makes a whole lot of sense. And something else that I want to add on is this notion of stable coins, which there's a lot of, right? The big ones from the US, like the Gemini one, Gemini's USD, USDC, which is from Circle and Coinbase, is like a partnership kind of. These are heavily regulated because they're entities in the United States. They have to be looked at by every single regulatory body, and they're audited regularly. So they are backed one-to-one. But something like USDT, Tether, that's where the question mark comes in. There's a lot of baggage with Tether that has occurred over the years. But the good thing is, whatever that may have happened before, I believe won't happen anymore, because they just got done settling with the New York Attorney General's office about shenanigans that happened between Bitfinex and Tether. Bitfinex basically had $850 million like locked up in some other bank. So they took an $850 million interest-free loan from Tether. That's what made them not be backed one-to-one, because they're missing $850 million. But since then, since this, they said they have replenished every quarter. They have to submit audit reports to the New York Attorney General's office, and they paid a fine. So going forward, I just don't see how they're going to mess around. They're being looked at, So what may have happened to Tether before that happened.
Yeah, and I get that with like maybe BlockFi. So let's say BlockFi is lending out and they've got these requirements of over collateralization, or just basically having more collateral on hand than what they're lending out. It makes sense. But the concern to me becomes what goes on in the institutional environment. why can institutions pay BlockFi, let's say 10%, for BlockFi to then lend it out at, say, 7% or whatever? There's that spread. What are the institutions doing to make this kind of money? And so my concern is, what happens if, the institutions, whoever they are, they borrow, I don't know, $1 million USDC from BlockFi or whatever, but then they rehypothecate that and they borrow, they take that money and basically lend it to someone else. So now they're taking borrowed money, they lend it to somebody else. Maybe the collateral requirements aren't as strict because they're like, hey, we're paying 10% interest, we need to make money. Here, we'll lend it to you, on credit, basically, collateral free. And you're going to pay us, 12 or 13%. But now as we keep going down this lack of transparent road, and ultimately we don't actually know whose USDC is where because we've just gone down this road so far. Right. Like the end user doesn't know that it came from institution C, which came from B, which came from A, which came from BlockFi, which came from Gemini, right? Like our transparency stopped at Gemini BlockFi. We don't know about the institutional custody of this.
Yeah, but if you think about it, why does it matter? So let me explain. I know that sounds bad, but why does it matter? So if you have institution A make $100 million loan, borrow $100 million, they may be greedy and they reuse that to lend to other people for higher interest, which could happen. So there's institutions B, C, D, whatever, right? Let's say all those institutions screw up, and institution A now have lost their entire $100 million. They put in $200 million collateral with BlockFi. So why does it matter if all that loss? It just means institutional A is now screwed and they lost their $100 million. So I guess my point is, yeah, of course the transparency would be nice. Just like we would love to see what hedge funds are doing behind the scenes right now. But, sometimes you don't get it. But ultimately, in terms of risk mitigating from BlockFi, they have that. And if somehow, let's say, whatever collateral that institution A put down, let's say they put down Bitcoin and Bitcoin goes down by half. Well, they will liquidate them half on their collateral and it doesn't affect BlockFi. So it would have to be some kind of catastrophic event where Bitcoin went down 90% and it just held there for indefinitely. Yeah. Right. And then in that stage, I would say they're all screwed.
Yeah, because in that case, then you get these institutions that are, potentially getting, beyond margin call, they're getting liquidated. They can't meet their obligations. And a danger becomes like, okay, even though BlockFi has the right to liquidate at, let's say, collateral level, 50% or whatever it is, well, like you say, hey, if it falls 90%, BlockFi, you're still losing money. You're still way upside down. You give people 48 hours and it continues to crash in the pan. There could be some issues there. And so I always look at that as like, look, obviously we don't expect that to happen. We don't hope that to happen. We don't want that to happen. But if it does, I like having that certainty that the whole thing won't collapse is important. And look, I own my Bitcoin. I've got about $1 million invested in Bitcoin related assets, Bitcoin related. I don't want this stuff to crash, right? One of the things that I do is I look at all the possible bad so that I can feel more comfortable in my conviction. Because like the last thing I want is me owning a bunch of a certain stock and then somebody going, well, did you know that this was a possibility? I better know about that possibility. Otherwise my conviction gets shaken, So one of the things with crypto is there is no Jerome Powell. There's no Jerome coming out going, no problem, market. Yeah, print money,
Some people used to argue that Tether was Jerome Powell, that you could just print a limited amount of Tether. But I guess, you got to just look at it this way. There's a lot of things that can't be controlled, right? There's big banks that we've trusted before that went belly up. Ones that have been around for hundreds of years. There's always a chance that something could fail. But that doesn't mean that no one is putting, depositing money into banks anymore just because some failed. Right. And with lending companies like BlockFi and others, it's a very small subset of what's out there. In terms of the number of holders of, let's say, Bitcoin, like look at the overall market caps, like $1.8 trillion. You look at how much value that these guys really have on hand. it's minuscule. It's not a big thing. So that's also the reason why I don't think there should be that much concern. But there is, of course, some concern that, hey, maybe these guys don't know how to manage their money and maybe they do screw up. So that's why, again, myself and I advise other people just not take a loan against their crypto because it could lead to bad things. But yeah, that's how and here's the other thing too. What's also evolving here is don't think that everything is like a BlockFi. There's a lot of actually true DeFi plays out there that is simply governed by code, where you can simply deposit and by code, you're going to get a rewards back. So there's different mechanisms for that. And those are like true DeFi. And I think the space is still very early, so that we're going to find some kind of balance going forward where there's going to be less risk, more automation. Let's put it that way.
Well, maybe touch on that because, first thing that I thought is, why doesn't everybody just put their money into like a BlockFi or Voyager? I mean, why not earn the 3 to 6% on your Bitcoin, or 5.25% on Ethereum, or 8.6% on USDC? I mean, geez, man, like just go refinance my house for 3% and go put it into USDC and make 8.6% that BlockFi has on their website. Why? Like, am I stupid for not doing that?
I've thought the same thing too, especially with a stable coin like USDC.
Yeah.
If it's anything else other than USDC, I think it's risky, because if you're mortgaging your house, you put into Bitcoin and you put into BlockFi, there's still a chance, even though they're giving 5%. What if Bitcoin falls faster than 5%? You're still going to lose money that way. So there's still a risk if you buy any other crypto to put it into a lending company like that. But USDC, I kind of agree with you. I've been thinking a lot about that. Like, why don't I convert?
Yeah,
I think for me, it's because I have all my money in crypto already. So, and I think I could gain more by doing that. But if you're conservative and you simply just have a ton of cash sitting around and it's sitting in a bank account, a checking account, or savings account that's not making much, this is definitely a big improvement and advantage by doing this, to put it into a stable coin, put it with one of these lending companies, or you just simply deposit. You don't have to actually borrow and just earn interest. I mean, that's a valid point.
Wow. Yeah. I mean, I usually see, maybe it's my real estate background, but in real estate, usually I hear high interest rate, like 8, 9, 10%. I hear risk. Like, it's just like a big, like, red flag, like this siren, like risky, it's like, oh, GUSD it backed 1-to-1 to, and you could earn 8.6%. And I go,
Yeah, I get it. I mean, that's why I think there is a risk involved. I think you asked the right question. I think a lot of people asked me beforehand to kind of address this before I came on, but I listened to what you said, and there is a risk level. If there's anything, whenever someone is holding your crypto, there's a risk level, no matter how much insurance or anything that they have. Just like the example with banks, there's going to be some kind of risk. So it just depends on your risk tolerance, I guess. But crypto, has been around for a long time. BlockFi, it hasn't been around for hundreds of years, but it has been around for 3 or 4 years now. If you ask them how much liquidity they have on hand, we're talking about billions of dollars. So, you have some comfort in knowing that they're not a mom and pop shop that just appeared yesterday with no liquidity and it's offering you this kind of interest. They are established, they are backed by some very wealthy investors and prominent companies. They have insurance, they're regularly audited, and you just got to figure that they know what they're doing, right? Of course, there's some risk, but I'd much rather put it into, say, BlockFi than some unknown company. And I'm not trying to endorse BlockFi. It seems like I'm really trying to endorse them, but I'm just using them as an example.
Yeah, I get that. Yeah. One thing, like, I see this comment here. Max says, ask Bitcoin, ask BlockFi. Everything is over collateralized. See, the thing is, I sometimes I get a little bit frustrated with the definitions that BlockFi uses, and it bothers me. Look, I like BlockFi, I like them there, but and I like to be so critical of things just so I can understand them more. It's not because I don't like them. I love BlockFi. I got a ton of Bitcoin with BlockFi. The thing that gets said is, okay, well, BlockFi over collateralizes. Yeah, well, what that basically means is you have $100,000 in your account, let's say, and they let you borrow 50%, right? I mean, this is no different than like real estate. It's no different than margin. In that case, every kind of loan is over collateralized because you're only taking out a certain loan, a percentage of your total value. On real estate, you're taking out, maybe 75%. On M1 Finance margin, you're taking out 30%. At BlockFi, you're taking out 50%. So this argument that like this over collateralization, that's just normal lending. That doesn't mean the value can't fall under what the borrowed amount was.
Yeah, that's exactly right. I mean, you look at shoot, I was going to make a good example of this.
Oh, sorry.
But it's okay. Shoot, I totally I lost.
Was it regarding the lending, the over collateralization?
Oh, yes. So I guess I was going to touch upon, what you said is exactly true. But with real estate, now you're an expert at this, but little that I know, just from what I've gone through. If you want to borrow against your collateral, the banks are very, very picky on, your income, your credit score. They want to see your cash flow. There's a lot of things that they ask you, right? For good and for bad, I guess. So they want to make sure that you're not going to default on the loan that they're giving you, right? So I guess the beauty of BlockFi is that they don't ask you all those questions. The only thing they care about is, do you have collateral? That's the only thing we really care about, is because if you default, we're going to take that away from you. So I think the simplicity of that is just much better. Like, there's a lot of people that probably have a lot of cash on hand. And let's say they want to go get a loan, but they have bad credit, or they have no credit at all, or no cash flow at all. They just have a lot of cash. Most likely the bank will not give them a loan. They're like, well, we need something. We need something, right? Yeah. But with the case of crypto, you have a lot of crypto, let's just say equivalent to cash, you will get approved every single time. And I think that actually is a more elegant system, because what ultimately comes down to is, can you pay that back? And if you can, great. If you can't, then we're just going to subtract it off from you, and that's it. It's as easy as that. So I think the system is just better this way. That's just
it was. So, and then maybe you could speak a little bit about. You had briefly mentioned it, DeFi versus CeFi. So centralized finance versus decentralized. I think when people hear crypto, sometimes they think everything's DeFi, but in theory, blockchain or BlockFi is a type of CeFi, right?
Yes. Okay. So DeFi is very broad. So exchanges like Coinbase and Gemini, they're also centralized exchanges because there's someone that's really running them. And DeFi can include DEXs, which is basically trading platforms that basically uses liquidity pools. So it's all automated, and it's based on people staking within those liquidity pools. Let's say you could stake ETH and BTC, and because of that pair, then people can trade against the two. So it's a new concept, but there are trading platforms called DEXs, but there's also ways to stake to get high interest, like these they call it like yield farming. So it's like liquidity pools where you can stake and contribute to that liquidity pool, and you could get massive interest from that too. So the project will share you, like, let's say, a cut of their fees, and also they have tokens themselves that they can distribute and airdrop among others. So there's a whole bunch of stuff that's really in DeFi, very early stage, but these are all like automated. There's basically no middleman, it's like no one to like really in the middle to tell you if one thing can't be done or could be done. It's all governed by code. And some of these are so decentralized that I guess for better or worse, you don't even know the team behind it. They're all anonymous. It's governed there, So sometimes it's good, sometimes it's not. Sometimes you do fail, but sometimes they work out to be fantastic. So that's the difference between CeFi and DeFi.
Yeah, I don't mean to interrupt you. I just got to unpack this a little bit. So, so the difference between CeFi and DeFi is CeFi, you've got corporations or humans still involved. So you've really replaced like the Fed or government with corporations in
Right.
CeFi. In DeFi, you're really you're code based. But then you talked about staking and liquidity pools and stake farming. Lost me to help me.
There's a lot. I mean, with traditional exchanges, is basically how much crypto they have on hand, right? Like,
But
if
that's the
you're
liquidity pool. It's like the all of the money that's available.
right.
Okay.
With DeFi, it's the same thing. If you're going to be making a trade, you have to have a pool of whatever you're trading that's available, right? You have to have liquidity there.
Sure.
So
Somebody has to be on the other side of your trade.
yes.
Yes.
Yes. And these projects, rather than they trying to accumulate all this, they allow the users to provide it. So yes.
Oh, so they're the clearing firm almost, rather than like the Apex for Robinhood or whatever, or the Citadel. They're the ones, like the code is basically trying to directly connect who's got the other money.
Right. So you think about they're just providing a platform, but the platform starts out with basically nothing inside. There's nothing
that's how
in
it
the
used to
liquidity.
be, though, right? Like way back in like 2010 or whatever with Bitcoin, there were no trading firms, there were no clearing firms. It was just like you had to wait until somebody else directly. Like, didn't you manually? And I don't know because I wasn't into it in 2010. But didn't you manually have to find the other person that you wanted to trade with? Like, you could just like, I want to sell my Bitcoin. You had to like manually scout out the other person to do the trade with.
Yeah, that I think you're thinking about like local Bitcoins, right? Something like that, where it's like a P2P like trading.
Okay.
Yeah, so that exists. Actually, it's funny too. I didn't know this. Just real quick about that. Like, it's actually illegal to be selling Bitcoin if you're an individual.
Okay.
Yeah, I didn't know that. So people that operate on local Bitcoins, they actually got arrested for that because it's categorized as like, I forgot what it categorizes you, like someone, almost categorize you as like an exchange. So you need to get regulated for that. And it's some weird thing, but I've read about people that have been like brokers where they sell Bitcoins directly to people, and they have been arrested for that. So first of all, that's not a good idea. So don't do that in the US. And I wish I could elaborate on the laws a little better, but it's something weird.
Yeah.
But anyways, but yeah, I mean, if you're like someone like Gemini, you need to provide everything. So you're providing a platform and you're providing liquidity. So you have in your inventory X amount of Bitcoin, X amount of Ethereum, X amount of whatever to be able to sell to people, and you replenish that. They have this, they buy it through the OTC market or whatever. They can balance it. If you're a DeFi project, you start out with just a platform and nothing. So all the buckets are empty basically. So you incentivize users to provide that liquidity. So you're like, hey, if you have some Bitcoin or Ethereum, you want to put it into our pool, we'll give you 30% interest APY for doing that.
That's nuts. Like, is it just so high because they need the liquidity? Like, hey, they can't operate their code without people attracted to their platform?
You should see that 30% is tame. Some of these pools offer thousands of percents for depositing. Which,
I mean, it just must be because there's no liquidity. Like, the reason you would offer so much of a percent is because people aren't using the platform. So they raise what they're offering to attract people to put their money there. And then, if I'm understanding this right, stake their money and go, hey, you could use my coin to transact with it as part of your software or whatever. But I mean, first of all, I mean, that sounds risky, right?
Yes.
On one hand, because it's like, the reason they're offering so much interest is because not enough people are using it. So there's that. But then somebody had to write this code, which doesn't the fact that somebody wrote this code in some sense make it centralized again?
Well, someone always has to write the code, but a lot of these are after they're written, they're governed by the people. They would have, say, a governance token so that you can actually vote on future changes and so forth. And a lot of these are open source, meaning that the code is available for everyone to see and audit and do checks. So that's one of the things. Like the biggest DeFi play in the space right now, they're called Uniswap.
Okay.
And Uniswap is backed by Coinbase and other prominent companies because Coinbase and others are afraid that Uniswap may one day overtake them, and that's why they need to invest in them to be sure. But Uniswap is what's called a AMM, which is the same thing where they have liquidity pools that you can provide your crypto into, and you can, by providing it, you can stake and earn high interest, and you could also trade with it.
That's this here, Uniswap announcing V3. So like somebody had to make the V3.
Right. Yeah. And there's a group of developers that is supporting it. So there is no doubt there's a group of developers supporting it. But this is open source code that anyone can audit and see if there's anything fishy going on. And because it's open source, a lot of other projects have basically stolen their code and create copies of this. And a lot of them have done very well doing so. So it's a very transparent market so that you could see what the platform is exactly doing. And also everything is provided by the users. So that in itself is much more decentralized. And plus their Uni token is also their governance token, which in the future will allow users themselves to dictate the direction of the project.
That's the Uniswap here or whatever. The Uni.
The Uni token, yes.
Now Ethereum has a larger market cap than obviously 2 bill. This just means that people have $2 billion worth of coins on the Uniswap pool.
Yes.
In it.
Yes.
Okay.
There's a website if you're curious. It's called DeFi Pulse.
Okay.
So just like how it sounds, DeFiPulse.com. And this shows you pretty much all the DeFi project, how much is staked within Ethereum. So right now you have $40 billion worth of crypto that's staked in DeFi projects.
Well, how do they measure that? I guess because it's all just open code or whatever. You can
they're all very transparent about how much they have, how much is within them. And if you go down the list a little bit, you'll see that Uniswap is at number 4. They have about $4 billion staked within, like the part of the liquidity pool. But there are others too. I mentioned about DEXs. I mentioned about these pools, but there's also pure lenders too. So you'll see like number 1, 2, and 3, Maker, Compound, and Aave, and they're labeled lending. So they allow you to basically put down collateral, and they will generate a stable coin for you to use. Maker has it. So Maker is a project that does that. They have a stable coin called DAI, which is pegged 1-to-1. And if you had, let's say, $1 billion or $1 million worth of, I don't know, let's say Bitcoin, you can put it on Maker and generate X amount of DAI, and then you could use that DAI for whatever purpose you want. Again, this is like DeFi lending, so it's different from than what BlockFi and others are doing.
So what you're saying is I can put my money over here with Maker and maybe earn some more interest.
Yeah, you could take that DAI that they give you. You could use that to buy more crypto. You can stake that to.
Where's that? Is that this? Is that Maker DAO?
Yes.
Okay. So world's first unbiased cryptocurrency, stable, decentralized currency that does not discriminate. Okay. I mean, it seems like very similar kind of arguments here. This 1-to-1 peg to the dollar. But what you're saying is I can deposit money here somehow, and then do I guess other things with it, like buy other cryptos. Isn't this like system like almost like feeding off of it? Like everything feeds off everything else. I mean, the more people use these miscellaneous, I should say, altcoins or these other stable coins, the more people are just kind of putting money into Bitcoin and the other things. I mean, like in some sense, I was thinking to myself, isn't it possible that the more money that goes into like the BlockFis or Voyagers, the more they can, in theory, themselves take that cash that they now have because they gave a stable coin, they got cash, and they could just turn around and go buy more crypto. So it's kind of like this self-fulfilling market in some sense, where you're building up, but then you worry, like, what's the risk factor on a potential down?
Yeah, that is a valid point. Like if you look at the overall market cap of the entire crypto space, it's about $1.8 trillion. Does not mean that there's actually $1.8 trillion in all of the projects. A lot of it is, generated by basically you're borrowing against what you have and you're putting that back into the system. A lot of that is like that. So there is some risk level there. I'm not going to deny that there isn't. That's why all lending projects or any project where it allows you to basically go on margin, there's a risk there. There's a risk there, right? So that is why that's just something that I don't participate in. And besides these, there's more things to DeFi. There's so much more to DeFi. There's synthetic token creations too, and you think like USDT. You think about like USDT or Ethereum, right? If you wanted to use that on another chain, you could create a synthetic, say, BUSDT or B ETH and use it on another chain. So there are synthetic tokens that you could also use for DeFi purposes. So there is a lot. There's a lot there, and I'm not going to sit here and say they're all awesome and they're all great. There is a risk involved with them, right? There is a risk involved with them, but right now that's kind of like what people are figuring out. That there's a lot that you can do with crypto and DeFi, and that's what people are figuring out.
Yeah. Now how do you think central banks are going to regulate all of this? I mean, we know that Jerome Powell has suggested the development of, at some point, a central bank digital currency. And these CBDCs, they're going to come. There'll be a Euro coin. China's working on one. How are these going to impact all of the other stable coins? I mean, like, if there's actually a stable coin that's backed by the Fed, why not use that rather than a stable coin backed by a corporation?
That's a good question. So I'm going to explain it. Well, first of all, let me versus Bitcoin and then versus stablecoin.
Okay.
I think a lot of newcomers see that like a digital fiat, like a digital USD or something, will go against Bitcoin. It won't, right? Because the inherent properties of Bitcoin, for example, it's non-sovereign, no countries control it, right? There's a set inflation rate that is decreasing until it gets to zero. There's a set supply. So there's no monetary policy that can be applied to it, right? So Bitcoin is not going to be affected to, say, a digital USD, which is just a digital version of USD, which you could arguably say that they can mint more of it instantly. It's like it's much easier for them to apply monetary policy or to generate more. So versus BDC, totally different animals. Now versus stable coins, it's closer, but stable coins only operate on the fact that they only mint more if someone puts money into it. That's the whole point of stablecoin. If you want $100 million worth of USDC, let's say, you have to go to Circle and say, here's $100 million, create 100 million USDC for me. They don't just automatically print or mint more and just put into circulation. That's the whole point of one-to-one backed. So the digital USD, when it comes out, it's not going to, yes, it's pegged to $1, but there's always going to be more coming out. And whenever Powell or whoever succeeds him will say, we need $5 trillion more, we'll just go ahead and create more. But stable coins will not be doing that. So there is still a difference there.
I see. Yeah. That does make sense. So yeah, nobody's going to take away Jerome Powell's money printer.
Exactly.
I guess the big difference then becomes the backing, because if the one-to-one peg falls apart in market trading, because they are traded on the stable coins, USDCs or the tethers or whatever, that falls apart. There's no backing. whereas now you've got drone backing, a central bank digital currency. Is that potentially preferential? Like, would we prefer to have that kind of backing, or does that just rub against the face of the whole crypto movement, which is getting away from a JPOW? But then on the flip side, it's just really turning corporations into that.
Well, you got to look at it like this. USDC is not meant to be a store of value. It's meant to be easily. It's a digital currency that's easily moved between exchanges. Honestly, that's the whole purpose of it. So that if you had 100 million of USDC, you can move it between Coinbase and Binance or anywhere else very, very easily. And the whole purpose of getting it is to buy crypto with, because a lot of these exchanges, quite frankly, is very hard to do a fiat buying, right? There's just a whole lot. And that's the whole purpose of USDC or stablecoins. So, I mean, if you're looking at something that should, like, you could argue that POW backs, the U.S. government backs the USD. Of course, you can't dispute that. The USD, I mean, the infrastructure of America is backed by USD, yes. But, you know, stable coins are not store values. Bitcoin is. Bitcoin is an asset, right? So you could argue that one day somehow real estate all goes to zero. Was it likely to happen? No. Sure. Can the government seize all the real estate in the United States if they had a reason? But but it's not likely, right? Yeah. So I mean, it's kind of like that. So I guess, you know, this notion that, again, going back to where Bitcoin can go to zero. I mean, technically, of course, anything can, but is it likely? No.
Do you think Bitcoin and or some form of cryptocurrency will replace the dollar entirely? Like, will the need for fiat go away? So I guess the question would be, will Bitcoin or some other replace fiat?
I think a lot of people want to see that. I don't think it's realistic. I think it's not suited for it, although someone like Michael Saylor would argue against that, because there's a lot of projects that's called layer 2s that are being built to make Bitcoin and others more useful. And you hear that a lot with Ethereum because it's pretty slow. They're trying to upgrade as fast as they can, but it's very slow. So you have these projects that are called layer 2s, which is basically compatible with Ethereum, but it's much faster, and it can get dApp makers to transit to a layer 2 very easily. So basically move from one chain to another. Bitcoin has something that's called Lightning Network that is trying to make it faster too, so that you can use it for day-to-day purposes. Like, you could use it to buy coffee with, and it'll be instantaneous, because normally a Bitcoin transaction takes 10 minutes because that's when a new block is found, right? So, but I don't see Bitcoin moving toward that direction. Maybe one day it will, and I'm wrong, but I see Bitcoin being something that countries can possibly hoard. You know how United States and all these countries hoard a ton of gold, you know, and a lot of it was because before, when the policy dictated that you have to have an X amount of gold to be able to have X amount of fiat, a lot of it was from that. But ever since I think Reagan or whoever took the USD off the gold standard, it's not really relevant anymore, but a lot of countries have a whole lot of gold. But I see the same thing happening with Bitcoin. As institutions, you know how we said about institutions being late to the game versus retail? You know, I think countries will be also late to Bitcoin, because why
they'll
would
be
you
last,
not?
huh?
What's that?
They'll be last.
Yeah. So hopefully that answered. I don't know if I went too long with that.
No, that's good. So, okay, not expecting it to take over, but what do we think about, like, there's this whole talk about proof of stake versus proof of work, right? Bitcoin's using proof of work, burning electricity essentially, and Ethereum's proof of stake. What's your take on that?
Proof of work requires a lot of miners to solve this equation, and the biggest argument against it is it takes an enormous amount of energy to do so. The counterpoint to it is most miners and mining farms are utilizing green energy, like water energy from waterfalls, or wind energy, and some are solar, right?
Right.
So, proof of work, there's a beauty in that, because the larger the network becomes, the harder it is to hack. So Bitcoin network is arguably the most secure network ever built by man. It is the one
Wow.
network that hasn't been hacked yet,
Yeah.
or ever. So the more you have, the bigger the number of miners there is that's trying to solve this equation, the harder it is to hack it. So there's a beauty in that. Proof of stake, on the other hand, is where anyone can download some code, some program into their computer, and you simply stake some coins or tokens, and you can basically help power the network by just holding on a few tokens. So does it take a lot less electricity? Yes, a lot less. But some would argue that it's not as secure, because some projects that are proof of stake have very limited number of nodes that's powering the network. So you could also argue that it's more centralized and that it's not as secure. So there's going to be this debate that goes on forever. Bitcoin maximalists will always say proof of work is better.
Right.
But usually everyone else, like new projects, like any new project that's an altcoin, will argue that proof of stake or a variant of it is better, because it's just easier to do, and there's so many variations that you could do with it. So that's kind of the difference between the two.
I see. Any concerns, because you're 50% Bitcoin? Any concerns with a move towards staking?
What do you mean, like staking the 50% Bitcoin?
We don't need proof of work. Like if in the future we end up determining, hey, the other services like Ethereum's proof of stake were just as secure, why not get rid of the burning of the electricity part in terms of proof of work?
Well, keep in mind, Ethereum right now is still proof of work. They're trying to move to proof of stake.
Okay, so they're transitioning. Okay.
Yeah. So, but to answer your question, no, I don't think Bitcoin network, the proof of work, will ever go away, because Bitcoin ultimately is like I said, different. It has the fundamentals, first of its kind, and it's transitioned to a store of value, while all these other projects are trying to become the next tech powerhouses of the future. And they need to continue to innovate and get faster and more secure and more and easier to use and all that. Bitcoin, on the other hand, is not threatened by that. They're digital gold. Gold, and it's almost like, have you seen this movie? I think it's called Just in Time, or In Time, with Justin Timberlake. You remember that movie?
Can't recall it.
Okay. Well, it's a weird movie where everyone is imprinted with like a clock on their hand, and if you run out of time, you die. And the rich will have a lot of time, and the poor have to keep working to make sure their clock doesn't run out. It's a very interesting concept. But in that video, I in that movie, I mentioned this because the ultra rich will have basically like a hard drive in their vault. And that vault is basically storing time that they can use at any time. So I see Bitcoin being the same thing. In the future, everyone is to go keep their Bitcoin on a ledger or hard drive or something, and they're just go store it in their own vault. And that's just gonna be it. They're just go hold on to it and wait the value to keep going higher and higher and higher. And if they happen to say want to use it to buy a house or a jet or a yacht, they can still send it, but it's not going to be something that they use every day to buy coffee with or something like that. That's how I view it.
I see. Okay. Now, Voyager, a company Voyager, I talked to their CEO, and they mentioned that with their coins they do staking. And one of the concerns I had, and maybe just need to understand it better, is if a Voyager coin is going to be based on staking, and then they do lending on top of this setup, I mean, isn't in some way the whole balance of the cryptocurrency of let's say a Voyager coin, isn't the whole balance of that at risk in the event the value falls? Now it's like the value of the collateral falls on the loans. Now the value of the staking falls. Like, or is there a separation between the value of the stake and its actual relative value to other coins? Does it not matter?
Voyager works a little bit differently, and I was trying to talk to Steve beforehand, but I couldn't.
Yeah.
But they're interesting because they don't require you to stake. They just require you to hold a balance, and that's it. And you earn interest. So unlike BlockFi, where you deposit to them, it goes in cold storage, and then it takes a long time to even withdraw. Like I think over a week to withdraw. Voyager, all you have to do is hold Bitcoin in their wallet, and they're giving you interest, which is very, very interesting. And you can withdraw that at any time. There's like no delay at all. So, I mean, I saw the interview that you had with Steve, and he explains it pretty much. I think it's the same way as how others do it, but I don't know how. It seems like their system is a little bit different. I can't really explain how they do it versus some of these other guys like centralized lending platforms. But ultimately, how they make money is by lending it out. And I think Steve even said on your show, they were lending it out to institutions that may be doing high-speed trading or something like that. But Voyager's a little bit different because they do have their own native token. So keep in mind, and they're publicly traded. So they're really unique in that aspect.
Right.
So they're publicly traded in Canada, but even though they're based in the US, and they have their own token. So they like have multiple sources of funding, I guess. So their token also provides, liquidity to the project. So I'm assuming, I don't know this for sure, a lot of these projects that have their own tokens, they have hundreds of millions to billions of dollars worth of liquidity that they can use to provide better interest rates. So if they needed to, that they can sell their own token. Because if you look at Voyager's token, VGX, which has gone on an extreme tear recently, they're valued at $1 billion, I believe. Last time I checked, I think they were around $1 billion. $1.1 billion. So I'm guessing in a worst case scenario, if they needed to get liquidity somehow, they could sell off their own tokens. So that's the difference between them and say someone like BlockFi. But again, I'm just making assumptions here because I don't know exactly how they do it, but they're a little bit different than everyone else.
Gotcha. What about this this NFT craziness? And I'm calling it craziness because maybe I don't understand how, like the New York Times the other day, and I brought this example up a couple times. I was reading a New York Times column. They're like, "Oh, we're selling this New York Times column as an NFT," and the same day it sells for like 350 ether or something like that. It was like $600,000, and I'm like, "Oh my gosh!" Like, so somebody has a it was like a PNG ownership of the column that was in the New York Times. First, NFT from the New York Times. How do people value this? Like, is it just the industry buying this stuff? Is there like are they actually going to be able to resell this?
It's the best way to think about it is it's almost like emotional buy, like an impulse buy.
Okay.
Like just like sports cards, or I don't know, you could argue sneakers or anything, art, right? There's a value to what someone declares it to be, I guess, right? If you love something, you just want to buy it. There's some kind of emotional attachment to it. That's how it's judged right now. That's why there's some sales that are crazy. Like Jack Dorsey also sold his first tweet for like $2.9 million. Beeple had his like Mirage kind of thing sell for like $69 million to someone. I mean, it's just these guys value it that much. But here's the thing: what people need to realize about NFTs is they're all one of ones. So there is a scarcity aspect to them. So that, just like anything else I mentioned about collectibles, the more scarce it is, the more valuable it is. And the same thing with Bitcoin. There's only going to be 21 million. So NFTs right now is trying to find that price point. There's a lot of marketplaces. We don't know how to value it based on just whatever someone's paying for it. That's really it.
Right.
But there is a scarcity aspect to it, so that it is driving demand up, and you can actually also verify and authenticate something with NFTs and make sure that what you have is real and legit and it's serial numbered, basically 1, right? So there are aspects to it. But in terms of the craze that's going on right now, it's undeniably, I mean, there is a craze.
Yeah, I mean, like, I know that people say there's scarcity, and I've heard this. One of my concerns that I have when I hear, oh, there's scarcity value, is the New York Times can NFT every single article they do. Sure, each one is only going to be 1, but they can do every single one. I can NFT every YouTube video, every tweet, just NFT everything. At some point, even though it wasn't the first, but at some point, I start diluting the value of that. And then, like, how are we going to trade? I don't know.
Again, the open market will dictate that. But there are certain moments, right? Like, all these articles. But let's say, I don't know, your favorite sports team wins a championship. I'm just going to go with Chicago Bulls or something, right? Especially when I grew up with Jordan, there's going to be certain articles where it's front page, Jordan wins his 6th championship, 5th championship. There is something to that people really want. Again, that emotional attachment. It doesn't matter how many New York Times NFTs have been created. You want that one for that moment, right? So it'll be the same thing where you can create as many NFTs as you want. If no one has some kind of emotional attachment to it, that they want it, they're not going to buy it. And the market will dictate that. So I think there's going to be certain occasions, certain things that people want more than others.
I mean, I get that. Like, look, in 2014, when I always refer to this, Germany in the semifinals scoring, 7 goals in soccer in the semifinals of the World Cup. That's crazy. Like, that's a moment that doesn't happen often. And so, like, I love that. But the problem that I have with that is that emotion fades over time for others. Like, when I talked about that soccer event in 2014, everybody knew about it. Now, like, nobody knows about it and remembers it anymore. So that emotional connection, as high and hypey as it was then, is worth, in my opinion, way less now. Like, it's not, that emotion is not going up because there's no hype around it anymore. It's actually going down. And so to me, it's almost like if I buy an NFT associated with a moment in time and an emotion in time, I'm actually buying something that is going to decline in emotional value over time, which presumably means it's going to decline in monetary value over time.
I would say yes and no, because if you have such an emotional attachment to it, there's guaranteed there's someone else that has just as much emotional attachment. Maybe not the masses, but there will be individuals that will have the same kind of emotional attachment.
But they got to have the money.
Right. Right. And that's the other aspect to it, is the money part, the speculative part. People will get in just to try to create, to generate money. But some will keep it because of that emotional attachment. And of course, the money aspect is a bonus. So I guess right now, the best example of this is NBA Top Shots. I don't know if you've heard of them, right? So right now, sports cards in general, sports cards, especially basketball cards, is blowing up like crazily. Okay. I have a really good friend that's into cards. Before 2020, everything was really down. After 2020, things have gone up tenfold, 100-fold. So a lot of those collectors, they got in because they love the player. They remember their childhood. They held on to them even though they didn't have a lot of value. But now they do have a lot of value.
Sure.
But it makes their conviction, I guess, they're even stronger because they see how it's worth so much now, and they love that card. So NBA Top Shots is an extension of that, where there are certain moments now, right, that you can collect. And there are some people that just love players, but other people are driven by the money of it too, which they're insane. They're these pack drops that they have. Sometimes they're $2,000, $5,000 pack drops, and they get sold out immediately because there's like 200,000 people waiting in line. And some of these players, these NFT moments, get sold for $100,000, $200,000 sometimes. So now I think it's a little bit different because the money is there, but also there's collectors. And let's just say, for argument's sake, like what you said, over time, the money maybe dilutes. It goes down because there are less people that care about that. But the true collectors will continue to hold it. And it could be where it turns around, where something else may spur up interest in that moment or that NFT. Right. And it could be very different. And I've had this thought about it. Like right now, they're not doing this because, of course, like let's say the NBA wants to make a ton of money. But let's say they evolve where you could buy a moment, then you can license it out. And you make licensing profits from that. Think about that. That would cause NFT moments or NFTs in general to skyrocket, right? Yeah. You buy a play from the playoffs or championship, every news outlet wants to use that licensing and you happen to own it. Think about how valuable that is, right? And there's other extensions to this too, where if you're a music artist and you sell an album and say that album gets sold and you get a cut every time it gets sold, think about that. You can make all this possible. It's just, it doesn't exist yet. But there's a lot of things that you could do with NFTs that just doesn't exist now. But it could evolve into something much bigger.
I mean, and that I like. See, I like investing in Square, for example. One of the reasons is because, and I'm open to putting more in Square, is mostly because you've got a potential play on NFTs with the music service that they just bought. We know Jack Dorsey just sold his tweet, like you mentioned, as an NFT. So I'm sure they've already connected the dots. You can almost guarantee it. And it makes sense for music and this redistribution purpose, especially if you can really like YouTube. They use Content ID to determine who's using the same content. It's almost easy to check now using algorithms who's playing my music without a license, who's playing my video without a license, right? That's great. Monetization purposes there. Yeah, that I like. Like, hey, you want to replay this? Cool. Like, you got to pay a fee or whatever. That's interesting to me. I guess more where I'm a little concerned is like, let's say there's this, I don't know, here's a picture or whatever, a portrait or whatever of Babe Ruth, for example. Let's put this up for a second. So something like this. So you put up a Babe Ruth or something. I don't know, that might be cut off because I didn't minimize here. But anyway, you put up a thing of Babe Ruth or something like this. Okay, cool. So people who saw him play, back, 100 years ago or whatever, loved it. And there's a huge connection here. But today, I feel like if I ask, 18, 20, 25, 30-year-olds about Babe Ruth, nobody cares. It's like, no, that's from a different century. Don't care. I'm interested in, Steph Curry or some whatever the popular player is of the day. I want a Kobe card or whatever. Isn't that a possible risk factor?
Well, just look at sports cards. Look at the oldest rookie cards for baseball, right? Yeah. I'm not that big into baseball, but how come the oldest baseball cards didn't drop to zero just because no one watched them? Because, right? There's always going to be someone that is going to be holding on to it, maybe because there's a value to it. They know they can flip it, or there's some other purpose. So just because a generation doesn't like them doesn't mean they just tank. Like, I grew up with Jordan, right? And now LeBron is getting old too. So maybe pretty soon after LeBron retires, who knows what, I don't know, Giannis or someone will be the new king or something like that. But doesn't mean that Jordan cards are just go die to zero. There's always going to be people that view him as the GOAT. And maybe in 100 years, no one is even around that has ever watched Jordan, right? But still, I don't think it's just go to zero. And I think that's
the concern here is collectible versus speculation, right? So at what point do we get to a collectible value, and at what point, or is it the same? Or at what point are we speculating that, well, I'm going to be able to flip this Top Shot clip to somebody else for more money next year? At what point do we separate that? And does it matter? Like, just let the market do its thing. And if a bunch of 95% of NFTs go to zero, oh well, people knew what they were getting into. And sure, those 5%, like the Babe Ruth card, those are the ones that legendarily keep their value.
Yeah, I think it determines on. I guess it determines on like how good you are at picking something, right?
Yeah,
Like
yeah,
right. It depends, because just like any asset, there's no guarantee that it's gonna go up.
right,
Going back to real estate, you buy a plot of land in the middle of nowhere with no development, you could hold it 100 years and it never go up. But you
yeah,
buy somewhere that's developing, it'll go up. It's kind of the same thing with NFTs. If you choose to buy NFT that basically no one will like, that is not going to be worth anything. But if you buy something like a moment,
yeah,
because there are licensing involved. So right now, there's a lot of people that create NFTs that they have no rights to create. So
right,
like with tweets and stuff like that. But imagine when there are a lot of licensing that's out there, and when you have like comic books too, you have the very first edition of Spider-Man or something like that. They're worth a lot, and the ones that have licensing, they can create NFTs that are the first edition, and there might be different editions or something like that, but you're still gonna know that you have the first one and the only one. And because it's an NFT, it's automatically authentic. It can't be duplicated. So there's a value to that. But of course, you have to determine which ones to buy and which ones not to buy.
right. Well, I mean, I get that with like it's authentic. There's only one, but some of those, like you look at the crypto kitties, some of them look so similar to each other. It's kind of like, yeah, it's not the same one, but it's really similar to the other one, you know?
Well, I mean, that's just how it is. I mean, a lot of cats and dogs look similar too, but you know what? You go value your dog and cat more than someone else's cat or dog, right? So it's kind of the same thing.
That's a good point. Yeah, yeah. I mean, okay, that's interesting. So I guess let me ask you: Are you investing heavily in NFTs?
No, not yet, not yet. Now there is. I'm kind of on like your boat. I feel like the market needs to dictate the price a little bit more. There's just too many wild swings. Celebrities are getting into it. Everyone is trying to get into the craze, right? So I think the market needs to dictate what's worth something, what's not. There's a lot of discovery at this point. So I'm waiting it out. But I'm looking at, there's a lot of promising projects out there that have the licensing.
Yeah.
I'm just going to name a few. Like, for example, Ecomi is the one that has DC licensing. They also have licensing with the NFL. So they couldn't possibly do something that others can't, right? So I am paying attention to projects that have exclusive licensing that can potentially create things that basically will have value, but I'm not there yet. But there are a lot of projects that do have official licensing, so you got to pay attention to them.
Huh. So that licensing is almost a key. Yeah, I like the idea of the music and the videos because you can sort of track that. But I was even thinking just like take some of the most popular NFTs, put them on an iPad, and put them all in my hallway. And they're not my NFTs, but just here's my NFT collection because it's like here it is. I'm showing off NFTs. I don't own them, but in theory, I'm getting the same kind of pleasure out of them. Unless the idea is to just really speculate on that appreciation potential.
I don't know how to answer that. Okay. If you were an art guy,
yeah,
okay, you can buy a replica of Picasso or replica of Mona Lisa.
And I do.
Right? Huh?
And I find the $30 Amazon paintings are fine.
But you cannot deny the fact that you would not rather have the real thing hanging up there, right?
I would sell it and buy Tesla.
Even a Mona Lisa, I wouldn't. I don't think that would be a good move.
The problem is okay. This is one thing I like about NFTs. I'll give you that is like I don't have to worry about my Mona Lisa burning down if I had one.
Right.
Like I'd be like so nervous. Like what if like the light shines in the wrong way and fades her face or something.
Yeah, I mean, yeah, I think it just really comes down to what your interests are, what you like. Yeah. Do you rather have an NFT just sitting there that's worth hundreds of thousands or millions of dollars, or would you rather have that in Tesla stock? Right? It just it's different for everyone, but there's a lot of people that made enormous amount of money with NFTs too. So so if you're just looking at it from like a making money perspective, then I would argue NFTs are great. They're great, right? But as a store of value, are they going to hold that value over long term? That's not determined yet.
Right. That's interesting. Yeah. So really, it's so early. We don't know the future value, and there's really no history to look at, like a Logan Paul NFT, because we don't have a precedent. It's not like, oh, well, here's this YouTube creator from 1950 whose NFT is now worth $1 billion. We don't have that.
Right.
So it's all kind of just like uncharted territory, basically.
Right. Exactly.
Okay, that's fair. So NFTs do not make it into your portfolio on that 50, 25, 25 because it's that uncharted territory.
Yeah, and NFTs is like, it is crypto and it's not like NFT is not a project. So when I say that 50, 25, 25, it's more investing into projects. NFTs, if I do invest into them in the future, it's not really in the 50, 25, 25 rule anymore. It's more like something separate.
I see. Yeah, I mean, here's somebody who's got a good point. It's like buying overpriced Tesla tequila because you like Tesla. Hey, I mean, that's a fair point. I mean, I spent $250 on a stupid bottle of tequila that hasn't even shown up yet, Now I could probably turn around and sell it on eBay for more. But
yeah, my friend got one. I don't know if it's limited now, but he got his bottle.
Yeah. That's awesome.
Yeah.
So you're not so worried about like BlockFi, for example, being a Ponzi scheme, going back to that, because I see a question here on that. You're not so worried about that, huh?
No, I mean, there's always going to be critics. There's still some people that,
BitConnect.
Yeah, some people will still say Bitcoin is a Ponzi. I mean, people will always say they'll bash what they don't know, or they'll bash what they're jealous of. There's legit concern, I guess, with something like a BlockFi. Of course, there's risk that's involved. Anything with lending, again, anything that you don't hold, there's a risk level there. But ultimately, if you look at who runs, let's say BlockFi, the security measures they have in place, the margins and the overall collateralization and everything else, there's no way they're a Ponzi. They're not a Ponzi. Is there a risk? Yes. Are they a Ponzi scheme? No. Just like Bitcoin. Is there a risk to buy Bitcoin? Yes. Is it Bitcoin a Ponzi? No. So, I mean, that's how I answer that.
Yeah. It's almost like I think people think of anything as potentially having fraud related to it as a Ponzi, when it's not even necessarily definitionally right. I think the big concern is people paying out like if, for example, if it ever came out that a crypto firm was basically just paying out interest payments on new deposit, like out of the coffers of new deposits, then that would be a little bit more concerning. But we haven't seen that. But then again, we also don't have as much regulation. Have you ever been concerned that, or have you ever thought that maybe once we actually get the regulation, then at that point Bitcoin goes to the moon, because it's like it's got that blessing of regulation, if it is a blessing?
Yeah, I think most people in this space will say the opposite of that regulations might drive things down. I think one of the ones that Mnuchin tried to implement and try to rush out before he got kicked out, basically, was this this KYC. Basically, he was trying to impose KYC on all the exchanges on every single deposit and withdrawal that they would have. So they would need to know who they are. So anyone that had their own wallet would have to declare who they are to these exchanges, which would be a big burden for these exchanges. Because right now, what they care about is if you buy on their platform, they do KYC, they would need to know who you are. But that's it. But if they have to track where every single transaction goes to and who they are and who they belong to, that would add so much more, headaches and overhead. So good thing when Biden took over, Yellen took over, basically they paused that. I think they're still looking at it, but a lot of Congress people and others have basically said that's not really a good idea. It's going to stop innovation. right? So we'll see what it is. It really depends. I think regulation is not all bad. I think in this space, there's no doubt there is inside trading. There's a lot of before exchange listings, certain coins pump up randomly, and then next day they're added on Coinbase. So there is insider trading info that's being spread. There's also uses of futures and options to drive things higher or lower sometimes. There's a lot of things going on that I would love to be eliminated. I think regulations will help with that. But ultimately, if there's too much regulations, I think it would be a bad thing. But this notion that, I think Ray Dalio recently said that he thinks if Bitcoin gets too big, the government will try to shut it down. I think they're more concerned about taxing people that have Bitcoin than trying to shut it down, because it's just it's a worldwide thing. You can't just really just shut it down. It's just way too hard. But I think what they really care about is how do we know who has it, who doesn't, and how do we tax them based on their gains? That's what they're really concerned about.
Well, and in theory, I mean, all the IRS needs to do is ask you for your wallet address and associate like on your tax return. And all of a sudden, all your Bitcoin privacy is out the window because now they're connecting your wallet ID to your social, which is connected to your date of birth, your address, your bank account. And all of a sudden, they know everything they need to know about every transaction. I mean, they almost get more knowledge about you by knowing your Bitcoin address.
Exactly. Well, so that's the thing. So the good thing about Bitcoin and pretty much all crypto is you can create unlimited amount of addresses, but you can't hide transactions between the addresses. That's the thing. So you have a good point. If they know this original address belonged to you, it doesn't matter who you send it to. They know that you sent it to that person. And it could be you, it could be someone else. But once they know you for life, and they'll have you on record. But but the good thing is you can have multiple addresses, and there are individuals. Well, I mean, there's a lot of individuals with addresses that no one knows about, especially the early people. There are some people that are, they could be the richest people on earth based on their Bitcoin, how much they hold, and just no one knows about them.
Wow, that's incredible. Yeah, I mean, geez, I wouldn't be surprised if in the future, like the Palantirs or the Snowflakes, these data aggregators, these big data operators, they are able to start linking like, oh, here's a wallet address, and it just webs out all of these associated conclusions.
they already do. There's a big company, Chainalysis. They just got some big funding. They actually work with government agencies. I think they do work with the IRS.
Biggest customer right there.
Right. So they do exist. And a lot of government agencies are utilizing them to basically track where all the funds are going into and stuff. I mean, there are legitimate reasons. Of course, they do want to prevent things like money laundering and stuff like that and illegal activities. But they exist.
Sorry, this one. There we go.
Yeah. They're actually the biggest in the space.
Yeah, but now I pulled up this other thing here too. I saw somebody mention this. Somebody asked a question about this here. So this is supposed to be totally private. Have you heard of this where they can't tell who you are or something like that?
Yes. Monero.
So what's the scoop with this? You're your own bank? I mean, what is this?
Well, everyone is there. Anyone in crypto, anyone holding Bitcoin is their own bank. So that's not the important thing. The important thing is Monero is completely private. They encrypt it in a way so transactions can't be tracked. So Monero is wallet, like with Bitcoin, widely used in the darknet, on the darknet. So there's a lot of transactions that people don't want to track. They use Monero, and there's other privacy coins like it. So governments around the world do not like it. So what they're trying to do is they make the exchanges delist it. So in South Korea, almost every single exchange already delisted Monero. In the US, I don't believe there's any exchange that has Monero listed. So I think the concern is they can't track it. Someone like Chainalysis can't crack it. So they don't know what's going on. So they don't like it.
Wow. Jeez. I mean, this is really incredible. What do you think about Tesla? Tesla buying Bitcoin. Should they have all of their cash in Bitcoin, or is it good that they just put a little bit in, whatever, 7% or whatever they have in there.
I think Elon is the type of guy that has bigger plans for it, and I think we saw that with the recent announcement that I mean, he already announced it before that he was going to allow Teslas to be bought with Bitcoin, but no one anticipated that he was actually going to run his own node and keep all the Bitcoins that he collects. That is a big departure, because everyone else that accepts Bitcoin basically gets it, converts it to cash, and that's it. Right. So they're not really holding on to it. But the fact that he's holding on to it, which means that he doesn't need to actually put more cash into it. Everything that he collects will just grow their reserves. So I think that's really big. But I kind of knew that Elon was going to do it. I mean, Michael Saylor had that little conversation with Elon on Twitter, and I knew that the two was going to hook up, and Elon was going to do it. Now, some argue, I think, that Tesla guys that don't like Bitcoin will argue that Tesla made a big mistake, and that's why their stock has come down and has not moved. I would argue that to a point, I think that Wall Street turned a little bit negative on Tesla because of it. But here's the thing. When the next big corporation announces that they're doing the same thing and adding $1.5 to $5 billion of their reserves in Bitcoin, it's going to change the narrative once again. And it's going to make Elon and Tesla and everyone else look like a genius. And ultimately, if you look at the bottom line, Tesla didn't declare what they bought their Bitcoin at. But people are anticipating somewhere around 48,000-ish, 48,000-ish. And people already calculated based on that and today's prices, Tesla already made like over $1 billion just from that Bitcoin purchase alone, right?
Right.
So how could you argue against that? I mean, that in itself is huge, but it seems like Wall Street doesn't want to pay attention to that. So
yeah, Wall Street's pretty good at sticking its head in the sand. So, and then following the trend later to say, yep, we were part of the trend.
Yeah, I think it's a growing trend. The rumor is Larry Ellison, obviously board of Tesla. Rumor is that Oracle will get in soon. Wow. Also, Twitter will probably be the next one too. Oh, because of Jack Dorsey.
I mean, Square's already buying Bitcoin, so that's never mind. Square's already in.
Right.
Square is PayPal, Tesla, and then a MicroStrategy. Yeah, geez, man, it's endless potential. What haven't we covered?
I don't know. We've been talking for what, 2 hours? Over 2 hours. No, go ahead. I don't know. I mean, I think we covered mostly everything that I think your audience would want to hear about. I mean, there's just so much. I mean, there's so much in the space. I think the one thing we didn't cover, and maybe we can do this on a future stream because I think there's too much to talk about, is the fact that some of these altcoins that I talked about, right? The 50, 25, 25, these altcoins, why are they different now than before? Why are they standing their own? Why are they actually gaining on Bitcoin? What do they do? What is their purpose? Because
Bitcoin. Do you have a 30-second version for that?
Well, think about anything that's centralized right now. It could be anything: social media, operating system, messaging app, anything out there that is centralized right now. Someone is trying to create a better form, a decentralized version of that. Yeah. And that is why it's very, very exciting in this space. There's so many that are trying to create a platform for other dApps to ride upon. Some are creating new browsers that is more privacy focused. For example, if you don't want Google to track all your emails and read through your emails and track what you're doing, right? You could download Brave browser. It's created by the guy who created Brendan Eich. He created JavaScript. He also created Firefox. And he created a project called Basic Attention Token, and he has a new browser that's very privacy-based. So there's a lot of things out there that's very exciting. Basically, anything centralized, there's a decentralized version that's coming out. I'm learning about new projects all the time. I heard one that's like a Ticketmaster competitor. There's a one that's a Spotify competitor, which is already operational, and they're doing very well. There's so many out there that are all trying to create the next powerhouse, and that's why it's so exciting. So I love to talk to you some more about that, some of these projects, but there's just so much.
So when it comes to Bitcoin, we already know that you do not think there's a high likelihood of this collapsing or going to zero. When are we going to hit the moon, and what is the moon like? Are we going to 100K, 500K? Any predictions?
Well, I mean, if you bought at 1,000, we're already at the moon, right? And that was not too long ago.
Yeah.
You know, there's some people that got in at $1, $10. It really depends on when you enter the game, but I think Bitcoin at a very minimum will reach gold's market cap, which would place it around $500,000 to $600,000. Basically, give it to the $12 trillion market cap, and then we'll see what happens there. Because if the trend continues where everyone starts really selling off their gold reserves and really utilizing that to buy Bitcoin, you're going to see so much more money coming in, and it's just going to be wild. But I think at a minimum, around there, 500,000 to 600,000. Is it going to come this cycle or next cycle? I don't know. I think this cycle, which should end at end of 2021, doesn't mean that it will, because I mentioned about institutional adoption, and this cycle is just very, very different than previous cycles.
Is that just because of so many people getting involved?
Yeah, because it's not just retail driven. You know, retail investors they have the weakest hands, right? If things go
yeah,
right. Institutional investors, they've been in the game for a very long time, and they have the strongest hands. And if they're buying Bitcoin, I don't think they're selling off anytime soon.
I guess one more that I do want to ask you about. What about the quantum computing risk?
So I have a really good answer for this. A lot of people think that quantum computers will break the SHA-256 encryption of Bitcoin's network. And if they do, they can basically do whatever they want. They could steal anyone's Bitcoin, and the network will basically get destroyed. Here's the thing. If you talk to anyone that really knows about quantum computers, you'll know that the operations, what they could do, is very limited. So it's nowhere close to getting that point. But if you do, let's just pretend for a second that in 10 years from now, someone creates the ultimate quantum computer that can easily break any kind of encryption out there.
Right.
Then you have bigger problems, because they can utilize that to break anything. They can hack into any brokerage, any exchange. They can hack into the US government. They could fire nukes. Like if it got to that point, the last thing they would think about is to break Bitcoin's network. They could do some real destruction. So that's why I don't think that's a valid concern, because if we ever did get there, we would have much bigger problems.
Wow. That's incredible. How long have you been investing in Bitcoin?
I got in 2013. I got into mining. Unfortunately, I got scared out. So 2014, when things came down, I got out. But I got back in early in 2017. So probably February timeframe 2017. So back then, Bitcoin was barely above $1,500. So something around there.
Wow. I mean, that's awesome. Good for you. I mean, what an incredible ride. Well, anything else you want to hit on? I mean, this has been very, very insightful. First of all, thank you so much for coming out here, and then definitely shout yourself out and your channel, how people can follow you.
If you guys want to learn more, check me out on CryptosRus. I stream 2 times every day, 11 a.m. and 8 p.m. Central Standard Time. So I give a lot of good info. But yeah, I mean, this was good. I don't have really anything else to say. I mean, I appreciate you bringing me on the show. I think we had a good chat. Looking at the live chat, everyone had a good time. So hopefully your audience learned a little bit, and hopefully you learn a little bit. And hopefully,
absolutely, always learning.
Hopefully we can talk again in the future, because there's so much more about these projects and what they're doing. I think there's just so much innovation happening, and I think it's really good.
Oops. Yeah, no, it's endless. I love it. Well, we'll definitely we'll catch up for a part 2 then. Stand by for a moment, George. Everyone else, if you found this helpful, like the video, subscribe, consider sharing the video, and folks, we'll see you in the next one.
Bye-bye.